people are going to be more bullish in theory right now for next year for stocks. In terms of what region people expect to perform best in 2026, the US is down a touch, but people are a lot more positive now about emerging markets.
In 2025, we've seen one of the widest performance dispersions across asset classes that we've seen in years.
The S&P is expected to grow earnings this year about 11.5%. That may prove to be conservative, as last quarter just sort of pointed to, but nonetheless, analysts expect an acceleration in earnings growth next year up to 13%.
Big changes in markets, they never start with price. They start with a structure. And what we are seeing now is not just another cycle. I think it's a quiet shift in how the financial market systems works.
Hello everyone and welcome to our annual investment outlook. What a year it has been. So we will review all of that and look ahead to 2026 very shortly. We've titled this outlook, Drawdown is Imminent. We will discuss all of that very shortly. As always, do have a quick look at the disclaimer. Remember that this is a marketing communication. It should not be taken as investment advice, personal recommendation, or an offer of or solicitation to buy or sell any financial instruments. Today, we're joined by the Dream Team, Lale Akoner, our global market analyst, Bret Kenwell, our US investment analyst, and Javier Molina, our Spanish analyst and crypto expert. For those that are watching on YouTube and those that are listening on podcast, the YouTube link is in the bio. Our dream team are all waving at you on the screen right now, and they're looking forward to being quizzed about the previous 3 months, the previous year, and the upcoming year as well. I'm looking forward to it. I hope you are all as well. Let's get into it though. Lale, what stood out to you so far from this extraordinary year?
Sure, let's look at what happened in 2025 across major asset classes, and then we would move on to what's lying ahead for 2026. Look, in 2025, we'd seen one of the widest performance dispersions across asset classes that we've seen in years. Obviously, at the top of the leaderboard, as we're showing here, gold has surged over 60%, really benefiting from an increase in trade uncertainty that we have seen with the administration in the US, higher geopolitical uncertainty, strong central bank demand, and also expectations for lower rates, right? So gold is at the top. MSCI China surprised to the upside. The sentiment in equity markets, they improved as policy support finally gained traction. And obviously that led to earnings momentum strengthening as well there. We have Max 7 and NASDAQ 100. They continued to perform strongly, although obviously we have seen more volatility this year as the market is still reassessing the pace of obviously AI monetization and also the upcoming CAPEX cycles as well. Broader markets such as the S&P 500, Stocks 600, and Japan, they did deliver solid double-digit returns, obviously supported by easing inflation, improving earnings, and also better capital discipline as well. On the weaker end of the spectrum, we've seen Bitcoin and the US dollar really losing ground as liquidity expectations are shifting and therefore the risk appetite also broadening out across global markets as well. So all in all, Sam, the message from 2025 markets performance is clear. Markets really rewarded quality, earnings resilience, and exposure to structural themes, particularly across AI, across energy transition, and also selective emerging market opportunities. Now, what are we watching for in 2026? I'm going to take a look at the first quarter. For 2026, we are going to start the year with the Fed decision coming at the end of January. Obviously, we will look to see whether the Fed will continue its rate cutting cycle because of the softening in employment markets in the US. Late January, we will have US earnings season kicking off. This is going to be the Q4 2025 reporting season. And obviously, it will set the tone for equity markets early in the year. I think that investors will increasingly focus on margins, on cash flows, and evidence of AI-related productivity gains. End of January, we will also be watching World Economic Forum in Davos, especially sentiment from global CEOs that can move markets at the margin. ECB is going to take a decision on February 4th and 5th. The second meeting from the Fed is going to come at the end of March. Early March, importantly, China's National People's Congress will happen. We will look for their growth targets, for stimulus direction, and any policy clarity on technology and industrial upgrading, which will be important for US markets as well. And finally, again, at the end of March, we will have ECB meeting as well.
Thank you, Lale. And for everyone watching on YouTube, I want you to describe 2025 in one word. Let me know and I will comment on my favorite. But Lale, before we get into other bits and pieces, the key drivers then for 2026, what have we come up with?
Thank you, Sam. Sure. Look, we call 2025 a year of policy uncertainty. 2026, we think, is going to shape up to be a year of selective growth, right? It will be about investors needing to be more discerning in terms of what will drive returns for the year ahead. The first driver that we will look for in 2026 is obviously earnings, cash flows, and capital discipline, right? Earnings quality, in our opinion, will remain front and center in 2026. Markets have become much less forgiving, and investors are rewarding increasingly companies that show strong balance sheets, that have pricing power, and that have disciplined capital allocation. So margins are still under pressure in certain industries, and we expect this theme to remain a major differentiator in 2026, and therefore also fundamentals becoming more important in terms of understanding which companies will be able to convert revenue into cash flow. And it's not just top line growth, and therefore those companies will be able to outperform 2026. The second driver is going to be monetary policy divergence. We don't think the global policy backdrop is synchronized anymore. The Fed obviously enters 2026 with front-loading rate cuts, while the ECB is taking a step back. Bank of England is somewhere in the middle. They paused for the past meeting. We expect them to cut this meeting in December, but it's more questionable for 2026 what they will do. So we are seeing a desynchronization across central banks globally. What that would mean for asset classes are obviously divergence in FX positioning, differences in duration strategies, and of course, global sector rotation as well. So expect some regional performance gaps to widen. And in other words, what works in the US may not be what works in Europe or Asia this year. The third factor is tech and AI developments and their earnings implications. AI continues to be a dominant structural force in the market, but the narrative is evolving. So we think that actually the investment cycle is shifting from the big tech beneficiaries to the broader ecosystem of, say, the data center buildouts or the semiconductor supply chains, cooling, power, and grid infrastructure, and high bandwidth memory. So these areas will likely attract a substantial capex in 2026. But this capex cycle also have real constraints, right? So it's about energy availability, materials bottlenecks, and the cost of scaling this infrastructure as well. So some volatility will be expected because these constraints will be top of mind as well. But again, the narrative is evolving, and we will see the focus moving away from the big tech beneficiaries into the broader ecosystem as well. For the fourth factor, we are looking at crypto tailwinds and regulatory clarity. My colleague Javi will talk about it more in depth. But finally, obviously, we're seeing institutional adoption for crypto. There is still some regulatory uncertainty But again, it doesn't take away from the deepening infrastructure, maturing investor behavior, and broader legitimacy of the asset class. We therefore say for 2026, it's likely going to be a year where, again, regulation provides more clarity, new product launches will continue and they will expand access, and obviously crypto will continue to integrate into diversified portfolios as well. So in summary, again, 2026 is less about broad beta and more about selectivity, earnings quality, policy divergence, AI infrastructure investment, and also institutional crypto adoption.
Amazing. Thank you, Lale. And we will be back to you very shortly. One of my favorite things about this podcast or video, whatever way people look at it, is the online survey results where we speak to people about their views as well. And what really stands out to me from the September poll that we run to December are that people are going to be more bullish in theory right now for next year for stocks, a little bit less so for crypto. So Javi, it'll be interesting to hear from you, and maybe people's minds might change. But also in terms of what region people expect to perform best in 2026, the US is down a touch. Bret will come to you shortly to speak a little bit about that. But people are a lot more positive now about emerging markets as well. They're a lot more positive about robotics when we talk about themes as well, clean technology, than they were in September as well. Energy in general, in terms of sectors people expect to perform best next year in comparison to September. Energy really stands out there, going from 10% to 21% of people that believe it could perform well. As always, let me know in the chat your views on all of this, and also 2026 in general. Really be interesting to get a discussion going. Bret, will come to you then over the pond. How are you seeing things at the moment as we enter the second half of the last month of the year, and 2026 is just around the corner?
Yeah, thanks, Sam. And, when we look at 2025, I think it's been a year that has continued to sort of defy the skeptics, and even as recently as this last earnings quarter. Coming to this most recent round of earnings, analysts were expecting about 7.5% earnings growth. The S&P kicked out 15% growth. So I think we continue to sort of defy the doubters, the skeptics, and that's a theme that we're looking at going into 2026 as well. The S&P is expected to grow earnings this year about 11.5%. That may prove to be conservative, as last quarter just sort of pointed to, but nonetheless, analysts expect an acceleration in earnings growth next year up to 13% in the S&P 500. And perhaps more importantly, they're expecting to see earnings growth from every sector. All 11 sectors in the S&P are expected to post positive earnings growth this year. If it happens, it will be the first time in 5 years, the last one being 2021, which was sort of a low bar to hurdle, right? Coming out of COVID, so many industries and sectors had negative growth that year. So really kind of looking for that big, diverse earnings growth from this group, from the S&P. But it's not just an S&P story. It's not just a mega cap story. In 2026, small caps are expected to really grow the bottom line and their margins and improve their balance sheets, and sort of see that financial traction that, quite frankly, I think a lot of people have been looking for over the years. And I've been in that group as well especially the last 12 months, but really maybe closer to 18 months, looking for small caps to get on board and join the bull party. Historically speaking, small caps are generally leaders early on in the bull market, and that eventually that leadership fades to the mega caps as we go through and as the bull market matures. It's not really the theme that we've seen in this bull market over the last couple of years. It really started with mega caps in the Mag 7 and has been trickling lower as we push forward. So the Russell 2000 will be a very interesting story as we look to 2026.
Absolutely. If we just move on to the next slide, I mean, for people watching this or listening to this, they'll be aware by now that the Fed have cut interest rates. But since that meeting, Bret, how are you seeing things from that point of view?
Yeah, the Fed was a big talking point in 2025, and I believe the expectation is they will be more of a talking point in 2026. Not only will we have a new Fed chairman, and will that Fed chairman be also facing some of the political pressures that we've seen on the Fed to cut interest rates in 2025, but There's also a growing divergence within the committee on what the best path forward is. And we've sort of started to see that in the last meeting. And I think Chair Powell actually summed it up really well when he said all the committee members, all the policymakers, they see the same problem. They just don't see the same solution. So there's really this argument between obviously the Fed's dual mandates, inflation and maximum employment. And there's sort of a difference of opinions on which one's the biggest risk, how they address each one of those concerns, and sort of what's the best path forward. But I believe I think Powell did a great job later on in his discussion, saying that while the policymakers do have a difference of opinion in terms of how to sort of orchestrate their path forward, the base case for none of these policymakers is higher interest rates. So that to me sort of says that rate cuts are more of a when, not an if situation for the Fed. It tells me that the Fed is not looking to be restrictive. They're looking to be accommodative, maybe not aggressively dovish, but certainly not aggressively restrictive or aggressively hawkish. So I think that is sort of a tailwind as we look to 2026. Maybe not right off the bat, and it wouldn't be weird if they kind of went through a bit of a pausing cycle themselves, but for 2026, we certainly have the Fed as a potential tailwind and not a headwind, which sort of brings me to the last point on this slide, which is AI. AI has been the pillar of the bull market over these last few years. NVIDIA has really sort of sparked this rally, and we've seen that rally filter through to different names within tech. I think to Lale's point, 2026 may be the year where we start to see AI trickle down into different subcategories within tech, trickle down into different areas outside of tech even. And she said the magic word for AI, which is productivity. If we start to see those productivity gains, that really gives a lot of potential, not just to tech and not just the semiconductors of the world, but be it in software, be it cybersecurity, be it in energy. I think 2026 really has the potential to see AI take that next step forward. And for as much discussion as there is about a bubble and as many worries as there are about a bubble, we still have fairly reasonable valuations, particularly in mega cap tech. You look at something like an NVIDIA, trades at a relatively reasonable valuation. You look at the Mag 7 in general, trades at a relatively reasonable valuation, given their growth rates and given what we're seeing in this space over the long term. So I think AI really has that potential to continue being a catalyst for this bull market.
Yeah, I'm with you. It's quite interesting looking at the bottom right chart there. Again, if you're on the podcast, link is in the bio to follow along. I'm going to make a very unbold prediction that next year you're going to see more AI mentions in a quarter than you have this year. And also, if anyone's got time, go through all of these outlooks, because I'd imagine that this particular outlook has had the word AI mentioned the most. At least that's what you would expect. Lale, we're going to get on our plane and we're going to travel back to Europe.
Sure.
What are you seeing?
Yes, for 2025, as I said before, Europe delivered a surprisingly strong performance. I think again in 2026, the narrative is similar, that it's going to be about selectivity. There's still supportive backdrop coming from policy, especially fiscal policy. There's lower inflation, still attractive valuations compared to the US. They all support the sentiments. That said, Europe is facing tariff pressures, geopolitical frictions, as we all know, and even uneven domestic demand across countries as well. So the macro backdrop is better. However, the dispersion in Europe, which started in 2025, is widening in our opinion, which does mean that sector allocation and stock picking will matter more this year. In terms of going into the different regions and countries, Southern Europe leads, but again, the rotation risk is rising. Spain and Italy, they remain the standout performance. They're powered by strong banks, resilient defense businesses, attractive valuations. However, a lot of good news, especially around defense spending, may already be priced in, right? So that raises the risk of rotation toward the more cyclical sectors, such as banks with domestic exposure, industrials, and parts of autos as the year progresses. Now, in general, for Europe, what's needed to extend the rally, in our opinion, is earnings follow through, right? So profit growth for 2026 is expected to be mid-single digits. It's positive, but that said, it remains fragile. So we really need to see, without clear upgrades to earnings expectations, we will have multiple expansions that become limited, leadership that may shift from 2025 winners, and also returns that could be more muted and more uneven. Therefore, again, the next leg of Europe's rally, in our opinion, will depend heavily on quality and the breadth of earnings, not just sentiment.
Amazing. It's quite interesting again looking at that chart, and I'm quite happy that the UK isn't bottom on that. But fingers crossed for a good 2026. Emerging markets now, Lale, and I mentioned this earlier. One of the interesting things I found from our poll that we did was that people are more positive than 3 months ago on emerging markets. Do you think that makes sense? How are we seeing things at the moment?
Sure. Obviously, again, broadly easy policy helps, but also the weakness in the US dollar as well. So again, the improvement in EM is very real, especially in our opinion, across Asia. And it's driven increasingly by technology and by structural reforms as well. So a better backdrop for 2026 as well, Sam, but again, selection matters. So earnings divisions across EM are still, they've turned positive. They're led by Asia, where we're seeing technology, semiconductors, and governance reforms, which are gaining traction. However, at the same time, we have global fragmentation still ongoing and tariff shifts. They all mean that, investors need to stay selective across regions, but also that would lead to performance dispersion within EM that will remain wide, as I said before. In terms of sectors, semiconductors remain the anchor. That said, leadership is broadening. We have obviously Taiwan's TSMC, Korea's SK Hynix, and Samsung's. They continue to sit at the center of the global demand for AI build out, really benefiting from advanced chips, high bandwidth memory, and also data center infrastructure. But now, again, we're seeing this cycle broadening through packaging, foundry suppliers, chip equipment makers, and also power on materials providers. And these are the sectors that are increasingly participating as AI capex deepens across 2026. Internet and digital platforms are reaccelerating. That's the second engine of growth in EM's digital economies. And this is not only specific to China, platforms in ASEAN and India. So think about companies such as Grab and Sea. They're showing strong user growth, improving monetization, and rising profitability as well. So these are the businesses that are expanding into fintech, into logistics, digital services, and they're creating a more diversified EM tech footprint, if you will. And finally, financials, they are a long-standing backbone for the EM indices, and we think that they are on a firmer footing as well. Real rates are higher, credit quality is increasing, and rebound in domestic demand, especially India, but parts of Asian countries as well. They continue to strengthen financials in general for emerging markets. And obviously financials, they do really provide a useful ballast in portfolios, really balancing the high growth tech companies that drives much of the EM upside at the moment.
Thank you very much, Lale. Javi, I'm sure many people listening and watching to this will be waiting in anticipation for the crypto update. It's been a fascinating year. How are you feeling about it?
Yeah, I mean, it's quite interesting because for the first time ever, price and value, they don't go on the same way. We were used to get prices with not value, just speculation, just, okay, who's going to be the next infra that is going to success? Is JP Morgan going to use Ethereum or is going to use Solana? And at the end of December, we have seen as JP Morgan, they select Ethereum to go on chain with a new mutual money market mutual fund. So that's the great change. So however, Sam, before I started, I want to start with one simple idea. That is, too many people are worried about price, no, about what's going on with Bitcoin, with Ethereum, with Solana, with the altcoins. And I want to point out that big changes in markets, they never start with price. They start with a structure. And what we are seeing now is not just another cycle. I think it's a quiet shift in how the financial market systems works. So when markets get noisy, a step back and focus on what really matters. And that's why I start with the structural shift, because the financial market is changing layers, the software, just to be clear. So this is not about crypto as speculation. It's about how financial markets are moving on chain. And that's key to understand 2026 and the next following years, because this new technology, this new shift, what it means is that we go to faster settlements, we go to lower costs, we go to fractional ownership, we go to markets that are going to run 24/7. So it's about compliance that is going to build into the system. So I think that these things are already happening. It's happening in bonds, in money market funds. We have seen BlackRock, we have seen Fidelity, now JP Morgan. Some times ago, we saw JP Morgan that issue commercial paper on Solana, on chain. So it's native on chain. It's not what we are seeing now, that we're going to move the economic rights that we have with the stocks on the tokenized stock markets. In these cases, we are talking about native on-chain new markets. So that's why I think 2026 matters, because as Lale said, regulation is becoming clear. The pilots are turning into real systems. And countries, they are competing. I mean, it's amazing what is happening between Europe and the US. So that's why we have to understand this change, no? Because institutions are not driven by ideology. They are driven by efficiency and control. So they need regulated custody. We already have it. On-chain settlement, we are on the way. Institutional liquidity, that's what's happening with the BlackRock, for instance, money market fund that is on-chain. And tokenized collateral. For the first time ever, Bitcoin, Ethereum are going to be used as collateral. So if you want to buy a house, you can use your Bitcoin as collateral. So that's the change, and that's why it's important. If you go to the next slide. So here, one of the key points I think that we have to study, and this is going to be, I mean, you try to build a portfolio. That's why you need to understand this change that I was talking about. Because, for instance, stable coins, I think that is the new tokenized infrastructure, because they are the liquidity layer. So today, stable coins support most on-chain activity. So they represent more than $300,000. So they are using it not for speculating. So they are going to be used for payments, for remittances, for trading liquidity, for corporate treasury. So, I mean, for 2026, I'm expecting to grow to 500, 750 billion dollars. So this is important because you're going to see the changes in e-commerce, in the global payments. So you don't have to think in, okay, I don't want to invest in Ethereum. No, you have to think who is behind this shift in terms of, for instance, in terms of funds, in terms of ETF, who is playing this new trend? And here is where I think that we have some opportunities. If we go to 2026 opportunities, just to summarize, I think that we are going to see, as we turn into the investment opportunities, these key ideas: tokenization, stable coins, institutional infrastructure, so for the custody, for the risk and compliance, and some emerging segments as Web3. So the key signals to monitor, so the stablecoin market growth. In fact, in the last quarter of 2025, the problem we have is that no new money is coming into the system. So check the stablecoins. You have the first sign here. So it's a red flag. If you see that it's going to go down, that is what is happening now. So we have no new entrants. So check the stable coins, check this institutional adoption. JP Morgan, I mean, they were really saying, no, there is no value on crypto, no value on Bitcoin. And now they are using Ethereum. So that's the key point. So that's why I'm saying that this is not about speculation anymore. It's not about prices. It's about the new infra. So if you are thinking in 2030, so for instance, years, so in 5 years, so this is the real change. It's the same when we start in 2016 investing in Bitcoin, because it's the new, okay, new internet money, new whatever, digital gold. So now this is a change that you have to understand. So what more? So important. Now we're going to see a shift in the stable coins, because they are not paying interest now, but from now on in 2026, check which of these stable coins are going to pay yield. This is really important. And just to finish in 1 second with Bitcoin and Ethereum. So I think that it's really interesting because there is a deterioration in liquidity. In fact, the volume in Bitcoin, in Ethereum, they collapsed in the last quarter of 2025. I mean, collapse mean 90% down in terms of volume. So check what's going on with the volume, check the correlation with the risk assets. I mean, I think this is really important. And what we need is just to see that the institutionals are back, that we have seen these new institutionals just adding crypto to the portfolios between 1 and 3%. So this is really important in order to get this volume on chain again.
Amazing, Javi. I could listen to you talk about crypto all day and all night. Thank you so much. And I thought I would just add my 2 cents or pence or whatever you want to call it on Bitcoin, just from a technical point of view here. And I know a lot of people have talked about these areas, and I think they're important. I think with technical analysis, you want it to be obvious. You want it to be pretty clear. And to the upside, in and around $97,000 seems like a very important resistance level. We'll call it a zone, a few thousand above that. You obviously have 100,000. Very key psychological level, psychological handle. If at any point price closes a day or a week above that area, I think psychologically sentiment would feel a lot more positive. And then we could, in theory, or at least traders and investors may feel like the next direction of travel is to the upside. It is towards those all-time highs. But on the flip side, if we drop below 70,000, if we drop below those previous all-time highs that we had at the beginning of 2024, sentiment changes again. And next thing you know, we get dragged towards that 200-week moving average, which we haven't seen since Q4 in 2023. So we're kind of stuck in the middle of a range at the time of recording. And of course, things can change very quickly in a matter of hours, let alone days. So we'll see how we trade into the back end of the year. We'll see how we trade in early 2026. But those are the key levels that I'm keeping an eye on. At the same time, I encourage everyone in the chat to let us know your thoughts as well. What do you see for Bitcoin? What do you see for Ethereum? Positive or negative next year? Speaking of next year, Lale, back to you before we do our Q&A. 2026 investment outlook. What are we saying?
Thank you, Sam. Well, the good news is the environment is, again, quite positive for risk assets in general. We have obviously the more stable macro backdrop. Growth is still uneven across regions, but inflation continues to trend lower and interest rates are, in our opinion, finding a new floor. That will mean rate-sensitive sectors will benefit, alternatives as well, and cash that's set on the sidelines for some time can now be redeployed in 2026. So high-quality equities, companies with strong balance sheets, and selective duration all look well positioned as markets reward stability and cash flow discipline as well. The second theme is EV, AI, and crypto power hunger continues. This is a new investment super cycle, in our opinion. Again, a massive rise in electricity and energy demand is in place because of these structural forces that will remain. But that is creating more investment opportunities in battery technology, in grid modernization, nuclear energy, and the broader energy transition ecosystem as well. That's why we're saying that we have a positive stance on real assets heading into 2026. AI and tech arms race continues. I mentioned this before, but I want to mention again. Now the opportunities are expanding beyond mega cap stocks. We are moving from that very narrow group of mega cap leaders to a much broader opportunity set, such as software providers. We have obviously semiconductor supply chains are important, chip equipment makers, cooling and power specialists, and industrial automation as well. So yes, the volatility will remain in especially the mega cap tech stocks in this sector, but the breadth of opportunity, in our opinion, is finally expanding, especially into the mid cap tech, and that's obviously enabling the infrastructure behind the AI scale as well. US dollar weakness continues, in our opinion, but with higher volatility. Again, it will be one of the key factors shaping portfolios in 2026. We think, again, global investors diversifying out of US dollar holdings will be intact in 2026. This is driven by lower rates, by lower growth, and also political uncertainty in the US as well. But that said, I talked about policy divergence before, and that would mean that FX volatility is going to increase, really making selective hedging more important than ever. So what does it all mean in terms of possible positioning across asset classes? We have positive outlook on US values, small caps, emerging markets, especially in Asia, crypto and commodities. We're neutral on the more concentrated parts of the market in US growth, in Europe, in treasuries as well. And real estate is going to come under pressure, in our opinion. And finally, more cautious on cash, with especially rate cuts underway. The opportunity cost of holding cash rises meaningfully.
Amazing. And question for the audience as well. I just want you to chuck in a percentage. Quick question on how do you see the performance of the S&P 500 next year? Just whatever percentage you feel. Please do put that in the chat. Let's get a discussion going. Now time for the Q&A, and for those that join us regularly, Lale and I do a webinar for our club members every Monday. And a few Mondays ago, I asked them all to send me some questions in to put to you all, Javi, Bret, and Lale, and I've nailed it down to 2 each. You know the rules by now. You've got 1 minute to answer each question. Bret, I'm coming to you first. How do you think investors should think of diversification in 2026?
For 2026, I mean, I have a hard time not thinking of 2025 in terms of diversification. And, as poor of a performer as cash has been for the longevity of the year, those who had it in the beginning of the year were in a pretty good position to take advantage of the market pullback we saw in end of Q1, early Q2. And then, of course, with the exception of these last few months, crypto and Bitcoin specifically had a tremendous year. Equities, not just in the US, but around the world, have had a very solid year. And then precious metals, you've got your silvers have done well. Gold has done exceptionally well. So I think it's just a good reminder going into 2026 and really beyond that diversification can really be a big positive for investors' portfolios. And I know I'm probably coming up on that 60-second mark, but I'd be remiss if I didn't note gold is on pace to outperform the S&P for the 5th time in the last 8 years. So really something to keep in mind as we look forward.
Well, I'll forgive you. I love a stat, so that's a good enough reason to go over the minute. Javi, I could have bet my bottom dollar that people would ask about this question. They have for the previous quarters and they have again. What do you think about altcoins?
Yeah, I mean, it's that's the 2025 history, no? I mean, I think that as I said before, it's not a time for speculation. It's not a time where you have to try to find the next gem. I mean, this is not going to happen anymore because we move from retail pushing market, speculative expectations, whatever, to real value. So I mean, we have seen in the last 2 years, if you check what's going on with Cardano, with Polkadot, I mean, they are not even recover the levels of 2 years ago. So I think it's not a time for that. I mean, forget about that. You have another options. You can try to find value in crypto, of course, but in the sense that we were explaining. So where tokenization is going, what's going on with the stable coins, what is going to happen with these kind of stocks that are going to be live in next year. For instance, I was checking a new IPO that is supposed to happen next year is Securitize. Securitize is a platform that it was the technology that BlackRock used it in, for example, to issue the money market fund. So this kind of value is the one that you have to try to find, but not in the altcoins. I think that is really dangerous because of course, I mean, if you are a trader and you want to try to find the really short term, perhaps you have an option on this kind of assets, but it's not a good idea because the value is not going to be built in this kind of underlines.
Yeah, thank you for your honesty. I think people will appreciate that, despite probably not the answer that some people would have loved to have heard. But it is what it is. Lale, given the recent volatility, why are we still optimistic about markets heading into next year? And which parts of the market look best positioned to benefit?
Sure. Look, I like the US because of the fact that we're really seeing tangible policy tailwinds. Consumers are getting a boost because of their tax refunds coming in February.
Yeah.
That's a 44% year-over-year increase. That's going to help consumer discretionary. While, we think about also banks, home builders, and obviously it's going to be the election year for the US, the midterm election year. In that environment, usually we have staples and healthcare also outperforming as well. So that is one aspect of the policy tailwind. The second aspect is for corporates, as we know, the One Big Beautiful Bill, they help companies expense factory construction, R&D, capital goods. That's going to help pretty much all types of companies, but especially R&D intensive mid caps. Think about sectors such as technology, energy, healthcare, industrials, and also consumer discretionary as well.
Thank you. Now for our final 3 questions of 2025. Bret, your final one. What is your top risk in your view for next year?
Yeah, I think, this kind of sends me back to our recent RIB survey where retail investors actually said politics and geopolitical risks were top of mind for risks going into next year. And I think that's a really interesting change from what we've seen over really the last couple of years, which has been inflation and recession risks being the top worry. I think it'd be hard not to mention the labor market, specifically here in the US. The US consumer is responsible for more than 2/3 of US GDP. So to see a cooling in the labor market is something we have seen in 2025. If that becomes a more significant deterioration in 2026, that is a very clear risk. Although I would say a lot of times the biggest risk that ends up materializing is the one no one's really keeping an eye on. So expect the unexpected would be perhaps atop the list as well.
Yeah, expect the unexpected. Xavi, similar question, but maybe more crypto specific, or go whatever way you want. What is
Yeah,
the main risk for you to watch?
I mean, I think is the macro environment, because at the end, crypto is correlated
Yeah.
with risk assets. So at the end, what happens with Nasdaq or S&P is going to happen with crypto, with Bitcoin. There is not going to be a safe haven asset if the market goes down. So first correlation, if the market goes down, Bitcoin is going to go down. Second is the liquidity, the global liquidity. You have a proxy with the M2, just check it. If it starts to go up, then that's good for crypto. And just the last thing is that be careful, because there is a change in terms of whales, in terms of the players of the crypto space, because we are moving from the old waves to the new ones. So I don't know if the corporate treasuries are going to support market going down. What is going to happen? Is this going to be systematic, or is it going to be controlled? So I think that these are the key points just to check for next year.
Got you. And our final question, here we go, of 2025. How should investors think about potential drawdowns, Lale, in
Yeah.
2026?
This goes back to the title of our webinar as well, where we said
Yes.
slowdown is imminent. Look, it's true. I think the expectation is that the next few months in the market's going to be choppy, although again, as I said, we are broadly positive for risk assets. But one thing to remember here is that, drawdowns are very normal. They are part of the game, the cost of long-term returns, if you will. So when we look at the historical S&P 500 drawdowns, first of all, the S&P 500 since 1980 has experienced an average annual drawdown of about 14%. Yet, again, the index finished the year positive in 34 of that 45 years when we look at the historical performance as well. So volatility is not a signal to abandon risk. It's simply the cost of, again, staying in the game and for long terms as well. So we just want to long-term gains as well. So we just want to remind everybody of that.
Yeah, absolutely. I think the S&P was down, was it 15% to begin this quarter, and has finished up quite nicely. I am touching wood as I say that, as there's still a few days left of December. Things can change very quickly in markets, as we have seen. That brings us to the back end of the podcast, the webinar, whatever you want to call it. Javier, Lale, Bret, it's been an absolute pleasure to have you with us. The next time we speak, it's going to be 2026. So happy holidays, everyone, and thank you very much for joining.